Hi, this is Stephen Ertel with Consinity Financial. Thanks for joining me again. Today I'll be continuing my analysis of margin debt. If you missed my first presentation on margin debt, you might want to check that out on our YouTube channel. Otherwise, let's go ahead and get started. In my first slide, I'll be using credit balances as a percentage of total margin to support my conclusion that there is a lack of significant short interest in the stock market at this time. For those that might not be familiar, credit balances and margin accounts include cash and margin available for investing, as well as cash proceeds from short sales. So if you had $100,000 in cash, but you had also sold $100,000 in stock short, you'd have a credit balance of $200,000. Taking a closer look at the chart, in the summer of 2007, we see a relative peak in the level of margin debt, and following that, as margin debt and the S&P 500 began to decline, we see a rapid and dramatic spike in credit balances. This indicates to me not just selling in margin accounts, but especially as the ratio of credit balances to margin debt actually exceeds 100% in 2008. There was a very significant amount of short interest in the market at that time. Now shifting your focus to the current bull market, we've seen what appears to be a relative peak in the level of margin debt earlier last spring. But what I do not see, as we saw in 2007, 2008, a dramatic spike or any indication of an uptrend in credit balances. However, after the volatile start to the year in worldwide markets, I would expect to see evidence of hedging and outright short selling in margin accounts as the January numbers are released later this month. Looking at my next slide here, I'll be using free credit cash balances as a percentage of margin debt to illustrate what I believe is a relative lack of liquidity in the market at this time. Now, free credit cash balances, this is cash held in a margin account in excess of margin requirements. So this is cash available to be withdrawn by the investor. I view it as a buffer or sort of a margin of safety for investors who are highly leveraged. So if you're holding very little free credit cash in relation to your total margin balance, if we see a significant market decline, you are going to be hit with a margin call very quickly. Taking a look at the chart, we can see that in action. In 2007 and 2008, as the S&P 500 starts to decline, we see a quick spike in free credit cash. This is as investors are forced to sell. Now, in the current bull market, we've seen an almost steady decline in free credit cash as a percentage of margin debt, except for a hiccup in 2011 where we had a correction and some volatility. Free credit cash currently sits at a record all-time low relative to margin debt, and if my thesis holds correct, this is what is driving our elevated volatility over the last 8 months. Now, we're not talking elevated volatility in terms of all of history, but definitely more volatility than we've seen over the last few years. Next is my final chart of this presentation, one that I believe illustrates that margin debt and enthusiastic investors in leveraged positions are driving full valuations in the S&P 500. The blue line here represents the level of margin debt in real terms, and the green line represents the cyclically adjusted PE ratio of the S&P 500. This is also called the Shiller PE, PE10, and what it is a 10-year trailing average of a PE ratio of the S&P 500. The yellow dotted line represents the historical average of the cyclically adjusted PE going back 140 years. I did choose the start date of this chart in spring of 1990 because if you remember from my last presentation, this is where the growth in margin debt really started to diverge from the growth rate of the S&P 500. My takeaway from this chart is a relatively strong positive correlation between margin and cyclically adjusted PE, but also, except for the depths of the financial crisis, we've seen full valuations higher than historical averages for the last 25 years. And I would ask viewers, the current data coming out on a global scale, are we positioned for greater than average historical growth going forward as prices in the S&P 500 would indicate? Or are we in overvalued territory, potentially driven by leveraged investors? And on that open-ended question, I'll sort of wrap up my presentation here. Here's the takeaways. Margin debt levels have fallen roughly 10% since the spring of 2015. which I believe indicates a risk-off sentiment on behalf of most investors. And I'm curious if we are going to see a cyclically adjusted PE reversion to the mean as a result of this risk-off sentiment. However, the drawdown in margin has not been accompanied by indicators of significant short interest, but I think it's a definite possibility that data released later this month could reveal a change in that trend. Also to consider, free credit cash to margin indicates that we'll see continued volatility going forward, and market expectations of rising short-term interest rates coupled with lower implied forward returns could be making margin less attractive to investors. And that concludes my presentation. Thank you so much for joining me. We have some upcoming presentations for you guys, opportunities in emerging markets, and a history of the 30-year mortgage. Once again, my name is Stephen Ertel with Consinity Financial. We're a fee-only RIA in Spokane, Washington. We really appreciate you subscribing to our channel and looking at our future videos. Check us out online, www.consinityfinancial.com, and we'll see you next time. Thanks.